While cryptocurrencies have been there since long, their volatility had kept a lot of potential participants away from the crypto market. That's until stablecoins came onto the scene. As of May 2021, the market cap of stablecoins touched $100 billion. Let's try to understand stablecoins in detail in this video. A stablecoin is a cryptocurrency that attempts to peg its value to the value of another asset, like fiat currencies, commodities, and cryptocurrencies. Stablecoins are designed to maintain their price stability like fiat currencies while maintaining the security, speed, and low cost of digital transactions. The first stablecoin, BITUSD, was launched in 2014. It was created by Charles Hoskinson and Dan Larimer. Based on design, we can split stablecoins into three major types: fiat-collateralized, crypto-collateralized, and non-collateralized. First type of stablecoin is fiat-collateralized stablecoins. Fiat-collateralized stablecoins are backed by sovereign currency, such as the pound or the US dollar. It means that to issue a certain number of tokens of a given cryptocurrency, the issuer must offer dollar reserves worth the same amount as collateral. Commodities such as gold can also be used as collateral. The reserves are often maintained by custodians that function independently and can be audited for compliance on a regular basis. Well-known fiat-collateralized coins are Tether and TrueUSD. Second type of stablecoin is crypto-collateralized stablecoins. The value of crypto-collateralized stablecoins is pegged to that of other cryptocurrencies. Since the underlying asset is also a cryptocurrency, its value will change as per fluctuations in crypto value. Such coins are over-collateralized. It means that a relatively large amount of reserve cryptocurrencies may be needed to issue even a small number of tokens. For example, $2,000 worth of Ether may be held as reserves for issuing $1,000 worth of crypto-backed stablecoins, which accommodates for up to 50% of swings in reserve currency. Well-known crypto-collateralized stablecoin is BITUSD. Third type of stablecoin is non-collateralized or algorithmic stablecoins. Non-collateralized stablecoins are those that do not involve the use of any reserve asset. Instead, these stablecoins use algorithms and smart contracts to protect price stability. If the market price starts to fall below the value of fiat currency, the algorithms will remove tokens from circulation. If stablecoins' value rises above that of the fiat, the system will dump new stablecoins into the market. Thus it creates a decentralized and automated central bank that increases or decreases the stablecoin supply as needed to keep the price level. Well-known non-collateralized stablecoin is BITUSD. Number 1. Stablecoins protects traders and investors during volatile markets. In a bear market, traders can protect their position by exchanging their crypto with a stablecoin. Traders can also manage their crypto holdings by entering or exiting the market using stablecoins without converting them to a fiat currency. Also, not all cryptocurrency exchanges support the use of fiat currencies, leaving stablecoin as the only solution. Number 2. They make the crypto market efficient. As stablecoins' market capitalization has increased lately, so also has their liquidity. This leads to more accurate asset pricing, resulting in fairer asset prices and tighter bid and ask spreads. Number 3. Cross-border transactions with stablecoins are faster, cheaper, and more efficient than traditional SWIFT or Western Union methods. Number 4. Stablecoins are not subject to localized laws. Hence it can act as an alternate digital currency where economic uncertainty is a concern. Number 1. Stablecoins aren't necessarily stable. One example is Tether. It had consistently stated that it is 100% backed by the US dollar. But when Tether released a breakdown of its reserves in May 2021, it turned out that less than 3% of Tethers were actually backed by cash. Number 2. These coins are not supported by most of the federal banks. Hence adverse regulations can risk investments. Number 3. Stablecoins may have negative impact on crypto markets. When large whales move down the market, they can secure a significant blow to the price of cryptocurrencies while securing themselves to stablecoin. Number 4. Stablecoins may not give excellent returns compared to their crypto peers. For example, the USD coin has been consistently priced around $1. Meanwhile, at the start of 2019, Bitcoin's value was close to $4,000, but in May 2021, it was over $60,000. Investors are increasingly looking to stablecoins as a safer way to experiment with crypto market. At least 200 stablecoins have been released or are in development globally. Additionally, 2 United States dollars-backed stablecoins, the Paxos Standard and Gemini Dollar, have been approved and regulated by the New York State Department of Financial Services. Financial services incumbents are also eyeing the opportunity. JP Morgan, for example, has piloted and launched its own stablecoin. Meanwhile, a recent survey of central banks found that 2/3 of respondents are actively researching the potential impact of stablecoins on financial stability. In certain countries like Brazil, people are preferring stablecoins to their national currencies during uncertain economic conditions. Stablecoins have the potential to open new doors to the mainstream adoption of digital assets in day-to-day life. Though they have a huge potential in changing the global payment landscape, stablecoins are still in their infancy. It may take a while before we see them becoming a true alternative to fiat currencies.